Okay, good afternoon, everybody. Bobby Piton here. I was just on the phone, just getting off. Sorry about the delay. Finding out some stuff that people are asking me about with regards to some images and so forth. So, look, I hope everybody's having a good day. We're going to go over two things. We're going to go over Toll Brothers, and then we're going to go over the Federal Reserve minutes. So, hi, Jules, Emilio, and Mary and Dave. Good to see you all. So let's go. Let's get to it. Okay, we're gonna go and share my screen. We're gonna go into Toll Brothers. Toll Brothers reported yesterday. So let me go share the screen. 1 second, folks. And Toll Brothers is a home builder, and I want to share this because obviously home building right now is on everybody's mind, is whether or not the economy is going to add more housing stock, because obviously prices have gone parabolic this year. And as a result, the past 12 months, housing has really gone up. There should be more housing coming online to deal with the supply issue. So that's the deal. And I think Toll Brothers, with their release of their earnings, we should be able to look over it and kind of see what they're saying. And then between that and the Federal Reserve minutes that came out yesterday, we can get some other insights. Okay, so let me expand this. There we go. So Toll Brothers, let me see, just expand the font a little bit. And let's go and have a look at how Toll Brothers reported. Okay, so Toll Brothers is based out of Pennsylvania. Is that right? Oh, let's take a look here. Let me see. We're going to go right here. Okay. I think it's out of Pennsylvania. We can look at the end. It's not as important. Okay. So Toll Brothers, they do luxury homes. Net income was $234 million right there, $1.87 compared to $100 million a year ago. So they've doubled their profits year over year. And home sales revenues were up 37%. So keep in mind, folks, the lower end housing has not gone up anywhere near as much as the high end housing. So people are definitely building more expensive homes. The number of signed contract values is up 35% versus a year ago. So that goes to show you how many new homes are coming online. There's a lot of money going into housing because of the housing prices going up 10 to 15%. So even with commodity prices being higher, it's extremely profitable for these companies that are sitting on this raw land, right? They're sitting on a lot of land. That's what they own, and they're looking to possibly build that they can put the properties on the land that they own. And the backlog is up 55% to $9.44 billion. So you can see that's unbelievable. Backlog of almost $10 billion. Net signed contracts up 35% to $3 billion. Home sale margins 22.7% versus 21%. And wow, even their gross margin, it's up 170 basis points. So needless to say, they're very pleased, as you can imagine. This is the high end of the market. Our deep land position, look at that. They're talking about their land position. 340 communities projected. That's unbelievable. They're going to have 340 communities that they're expanding in. And so you can see the average delivered price of a home, $830,000. Folks, this is not a cheap builder. They're building in that $500,000, $1 million house range. The average home in America is probably about $250,000. So this gives you an idea that the wealthy, the wealthier neighborhoods in this country definitely need, the wealthy areas are doing a little better, which makes sense from the standpoint that a lot of the wealth that's accrued in the past year has been flowing to capital holders. Okay, so that's what's going on there as to why they're doing the count. But with these increases that we're seeing with housing coming online, it should hopefully take pressure down with regards to prices, Because if let's just say you want to buy a house and you can afford a house that's an $800,000 $1 million house, you want prices to come down, right? Because you don't want them to stay elevated. So this should be a good sign that housing is starting to come online and probably put some pressure on housing prices. So right here, you can see right here the number of contracts, 2,597 units versus 2,000. Now keep in mind, folks, it sounds like a lot, which I know it does, right? 2,600 units. And it is a lot, $2 billion. But this country has $30 trillion worth of homes on it. There's over 60 million homes in America, if you can believe that. So this is at the margin. It's going to help. But I'm just telling you that there's a tremendous amount of homes in the United States, and that, them building 11,000 homes when there's 60 million isn't a make or break deal, is what I'm saying. So here's so let's take a look what they're saying here. Anything else? Okay, so they're saying, 363, pre-tax income of 600.6 million. So needless to say, they are, where are they based out of here? Let's see here. Toll. They build in the top 24 states. Look at that. Arizona's listed first. This looks alphabetical. California, Colorado, Florida, Georgia. So all the faster growing states is where they're building. The economy speaking, they have $8 billion worth of inventory, $8.2 billion, almost $1 billion of cash right there. And then how much debt do they have? Well, they have debt of what? Let's take a look. They have debt of $1 billion in loans payable, $2.4 billion in senior notes. So the total liabilities are $6.1 billion. They have total equity of $5 billion. They've bought back $1 billion worth of stock. Look at that. They bought back 240 million shares, $240 million worth of stock in the past 9 months. And look at their retained earnings. They've made $5.5 billion of retained earnings. So needless to say, Toll Brothers is getting the job done, right? And let's take a look at how Toll is doing. Stock's up 4%. So it's worth $8 billion. And, it's the higher end markets of Pennsylvania. So you can see the stock traded down as low as 53. It's right back at 63. So needless to say, it's down from 67 in May. So it hasn't rebounded just yet. But here's a situation where, we can see that they're doing pretty well. The stock got as low when things got really crazy last year as $16. So it's pretty much quadrupled off the low. So that's the story with Toll Brothers. I have no opinion on the stock. I'm just bringing it up for you guys to think about things when you hear about things slowing down in the economy and all hell's breaking loose and we're all going to, everything is going to collapse. It's good to take a look at what's going on with some of these companies. That being said, just because economics are there and companies are doing well financially, that doesn't mean that we don't necessarily have social issues that are serious. And I don't want to boo-hoo those things. I think they are very serious. I think our rights are under siege. I think that we need to get much more involved as a society. We all need to become more active citizens. And every way that we can help is beneficial to all of us. Spend an hour, spend 2 hours a week, maybe more if you have time, especially folks that are retired. Get involved and take back our entire process from a lot of corrupt people that have kind of cocooned themselves into the political process in this country. It's really disgusting. We need more Americans that put America first to step up and fight on behalf of the U.S. Constitution and us, the American people. So anyways, but I just want to at least point that out to you with regards to Toll Brothers, that, I think housing is going to probably do pretty well in terms of as an overall sector. The question is, will the profitability be there? Right now, these companies' margins have expanded. We'll see if they stay there. It all depends on the commodity markets. But if commodities are coming down, some of the prices that should help their profitability. And so let's go to the Federal Reserve. So now if you go to the Federal Reserve, some open action, some of their open market committee minutes came out. So we're going to just click on this. You can go to federalreserve.gov, recent events, and this is a PDF. Hopefully the Fed's not giving me a virus or anything. So we can just go here and pull up the minutes. And I figure since we just went over housing, we can look over what the Fed is saying based on what they reported back in July. The Fed always delays the minutes about 1 month. And so this is a 1 month delay. So we're going to look at this and we're going to say they discussed, the board met subject to the review. They're going to establish the primary credit at existing level of 0.25%. So they basically were saying, no, we're not going to change anything. They were positive about the economic outlook and continued to report strengthening activity across sectors and districts. Okay? Businesses are having difficulty hiring and retaining workers of all skill levels. And there was labor shortages. Okay? Right there. Profit and wage pressure. Upward pressure on wages. So you can see that, right now, for people worried about the economy rolling over or collapsing, they're not seeing it, okay? That's not to say that it doesn't do an about face. I have no idea. Nobody really does. But right now, the data is suggesting that the economy is doing very well. It is strong, and that there is strong demand, right, for residential real estate. We just looked at that. And you can tell that by prices. If the prices are going up, part of it is money supply, right? They've been pumping a lot of money into the system. But that's why it's taking place, okay? So they've noted that inflation has picked up recently, and a lot of people are saying viewed as transitionary. I've talked about this transitionary concept that if we're bringing our supply chain back into the United States and it takes a little bit of time, that's why the inflation rate is a little higher than what they think it should be over time. Based on the 10-year, right, the 10-year Treasury or 20-year Treasury, if we just go here real quick, and you could just go to, if you just go to Google and we just type in TLT, okay, so that's at 1.62%. Actually, we'll go to CNBC. I think you can see anytime you want to quickly just take a look at what the 10-year's at, you can pull it up, popular quotes, UST, 1.35%. So that's what the 10 years at. It's at 1.35%. You can see that it was obviously, it was at 3%, folks, in 2018. So now it's 1.35. That gives you an idea how much it's fallen, the 10-year. So, to have money at 1.35% on 10-year, it's basically telling people to get involved and get your money invested. They're literally trying to scare people into investing in assets and in the economy. That's what's taking place. Okay, so in the fact that 10 years are not, the 10 years not going up, it could be manipulated, right? Because they have control of the money supply. So who knows for sure? When that's going to change. We'll be looking at it with regards to how the Federal Reserve decides to change course with regards to the size of their balance sheet. So we'll see if they say anything here. So as specified by the formula, hold on a second, this rate would be set 50 basis points. Hold on a second. So voting for this action was Powell, Clarita, Quarles, okay, Brainerd, Broughton. Okay, so now let's look at the next thing. Okay, interest on reserve balances, rates unchanged. So they basically said they're not going to increase anything. So they decided to maintain a target range of 0 to 0.25%. And so the board approved the interest rate paid on balances of 0.15. Now keep in mind, folks, if the Federal Reserve wants to pull money out of the if they want to pull money out of the system, they would raise that rate to encourage banks to lend less and just give them the money so they can get paid on their balances. The lower that number is, the more it pushes money into the economy. So the fact that it's at 0.15 is still very low. So it's definitely encouraging people to push money out into the economy. So that's the deal, folks. With regards to some questions here, I see that, let's see, is this artificial way a good way to inflate the U.S. debt away? Yes, you can definitely say that what they're doing is they're inflating the debt away. But I would take it a step further. I think that not only should they inflate the debt away, right, which is what they're in the middle of doing, because a lot of it's bogus. I think we need to audit the debt, and I think we need to write down all the fictitious debt that exists. I think a lot of it is not there. I think it's a scam, and I really do believe that unless we can truly audit it and see how much we received in goods and services for the money that supposedly the Federal Reserve spent, or not the Fed, but the U.S. government spent, we shouldn't pay back the debt. So I would not, if I was in charge of the books of this country, I would be like, we're not paying. I would actually probably default on purpose and say, you know what, I want to open it all up. We're going to do a forensic audit. I want to see all 20 years. I want to see all the paper trails of this damn money that you think we got from you, because I don't believe we got it. I think a lot of it is fictitious, folks. You heard it here first. We'll see. Just like I think they've been lying about the census data, they've inflated our population numbers to make it seem like we have more people here than we do. I think they've been inflating the debt. They've been cooking the books everywhere, it seems. A lot of really bad people got involved across all facets of government and have been screwing us for decades, folks. And it's all coming to roost. So that's the deal. Anyways, I hope you guys found this interesting. I hope you have a wonderful afternoon. And I will see you all tomorrow, unless you join me in the Bible study tonight at 8:30. I'll be on at 8:30 p.m. Day 186 out of 365. God bless you all, and I will talk to you soon. Thank you.